Hello, I'm Matthew, and in this special episode, we present our reviews of the most influential books that we've read. Book Review and Headlines of One Upon Wall Street: How to Use What You Already Know to Make Money in the Market by Peter Lynch. This book describes in great detail and examples how an ordinary investor can use what he already knows about a lot of companies whose products he uses regularly to invest and get a very good return on the stock market. Peter Lynch was the manager of the investment fund, Magellan, from Fidelity Investments between 1977 and 1990, growing its portfolio from $18 million to $14 billion in 13 years. The book addresses investors in individual stocks and provides plenty of examples of stock analysis from well-known companies such as Avon, Coca-Cola, Colgate-Palmolive, Exxon, Ford, IBM, Intel, McDonald's, Philip Morris, Procter and Gamble, Subaru, Toys R Us or Xerox. Some ideas from this book. An average investor can become an expert in their field and choose winning companies as efficiently as Wall Street professionals with just a little research. A stock is not really attractive until several institutional investors have recognized its value, and many analysts on Wall Street have not put it on the list of buying recommendations. Never invest in a company before analyzing the company's revenue prospects, financial conditions, competitors, development plans, etc. You do not have to make money from each selected action. From the author's experience, 6 out of 10 winners in the portfolio can produce a satisfactory result. Everyone considers themselves a long-term investor, including the audience traders who took a few free hours. Long-term investments have become so popular that it's easier to admit you're addicted to drugs than it is to be a short-term investor. People are advised to think long-term, but every comment on stock market fluctuations makes them look short-term market. It's a challenge not to act. If people check their stock prices every 6 months, as they check their car oil, they would be much more relaxed. It is important not to buy stocks or equity funds with the money you will have to spend in the next 12 months, so as not to be forced to sell in a declining market to get cash. When you sell desperately, you always sell cheap. When you are a long-term investor, time is on your side. Rule number 1 of the book is, do not listen to stock market professionals. 20 years of experience have convinced the author that any normal person, using the 3% of his brain capacity, can choose actions as well, if not better, than an average Wall Street expert. An American mutual fund cannot hold more than 10% of a company's shares, nor can it invest more than 5% of the fund's assets in a single company. Some funds cannot hold shares in a company worth less than $100 million. The individual investor has no such constraints, which can be an investment advantage. This explains why many mutual or pension funds fail to beat market averages. The larger a stock fund, the harder it is for it to beat the competition. Before you start investing in the stock market, you need to ask yourself: 1. I own a home? A home is a good investment that almost anyone can make. 2. I need money? Only invest what you have allowed yourself to lose, without this having any effect on your daily life in the short term. 3. I have the personal qualities to succeed? These include patience, common sense, failure tolerance, open-mindedness, detachment, persistence, humility, flexibility, willingness to research one's own, willingness to admit mistakes, the ability to ignore general panic and make decisions without you have complete or perfect information. 4. Uninitiated investor goes through 3 states: worry, complacency, and capitulation. He is worried after the market has fallen or the economy seems to be collapsing, which prevents them from buying good companies at a reduced price. Then after buying at higher prices, he is pleased to see that his shares are rising. This is the time when you should check the basics of your actions bought but do not. In the end, when his shares fall in hard times and prices fall below what he paid for shares, he capitulates and sells muffledly. 5. You have to discipline yourself to ignore your feelings and keep going shares as long as the fundamental analysis of that company satisfies you. 6. He doesn't believe in the predictions market, believe in great companies. The only reliable buy signal is a solid company. In this case, it is never too early or too late to buy her shares. 7. The best place to find companies that make 10x profits, 10 baggers, is close to home, shopping at the mall, and especially where you work, the advantage of the profession. This advantage is especially useful in the case of cyclical industries. So invest in things you already know. You can develop your stock detection system outside the financial information channels. From there you will receive the information late. 8. Even if an action caught your attention, its discovery is not a buy signal. You've just reached a point where a story needs to be developed. Investing without prior research is like playing poker without looking at cards. 9. The size of a company is important in relation to expectations. Success tends to dilute large companies over smaller ones. It is impossible for a very large company to accelerate its growth very much. Don't buy shares in a giant like Coca-Cola waiting to grow 4 times in 2 years. If you buy Coca-Cola at the right price, you can triple your money in 6 years, but not in 2 years. Meanwhile, a competitive product can launch a smaller company in a period of strong growth and is a more profitable investment. The companies are divided into 6 categories: slow growers, lazy, stalwarts, robust, fast growers, fast, cyclical, asset plays, asset holders, and turnarounds, returns, in a rough translation. Growth means that the company grows, more in 1 year than in the previous year. 1. Slow growers _ large and old companies, which grow slightly more than GDP, 2 to 4% per year, on average. They may have been fast-growing companies in the past, but when their industry slows down, most of the companies in that industry lose their pace, and sooner or later any fast-growing industry becomes a slow-growing industry. Examples of slow-growing industries: energy utilities, metallurgy, chemistry, computers. Tend to pay generous dividends, their main advantage. To buy if they have paid good dividends in the past. Find out the percentage of profit distributed in the form of dividends. If the percentage was lower, then the company probably has a cash pillow for harder times. If the percentage was higher, then the dividend may be riskier. For sale if they have increased by 30 to 50% or if their foundations have deteriorated, even if the price of the auction fell. Even at a lower price, the dividend yield may not be attractive enough to attract the interest of investors. 2. Stalwarts, robust, for example Coca-Cola, Bristol-Myers, Procter and Gamble, Colgate-Palmolive. These companies are more dynamic than the lazy, with revenues increasing by 10 to 12% annually. Depending on when you buy and at what price, you can get a reasonable profit with robustness. It can take several years for you to double or triple your money, at most, but it offers good protection during a recession. Before buying, check that you have not diversified your field of activity ineffectively, check the rate of growth of long-term income, and whether it has kept pace in recent years. If you are going to keep its shares forever, analyze how the company's actions behaved during previous recessions and falls. They are usually kept for a profit of 30 to 50%, after which they are sold and the process is repeated with other similar companies whose shares are currently undervalued. Sell if new products no longer have the expected success, if PER is already significantly higher than other companies of the same size of the industry, if the growth rate has decreased although it has maintained its profits by reducing expenses, and other opportunities to reduce costs seem limited. Fast growers. Small, aggressive companies, which grow by 20 to 25% per year. If you choose them wisely, some of them will bring increases of 10x, 40x. A fast-growing company does not necessarily have to belong to a fast-growing industry but to make a substantial profit. All it takes is space for expansion in a slow-growing industry. Examples of companies that have performed well in the past: Anheuser-Busch, produces Budweiser beer, Marriott, Walmart, Taco Bell, The Gap. Trick is to figure out when they will stop growing and how much to pay for that growth. Verify that the stock has APR close to the growth rate. These companies cannot maintain a double-digit increase in the long run, so sooner or later they run out and reach a one-digit increase as lazy or robust. Signs for sale: sales down 3% in the last quarter, various executives went to the competition, the stock is sold with APR of 30, while the most optimistic sales growth projections would be around 15 to 20% in the next 2 years. 4. Cyclicals. A cyclical is a company whose sales or profits increase or decrease regularly or predictably. Examples of pro-cyclists include the tire industry, metallurgy and chemistry, the automotive or aviation industry, and even the defense industry. In a growing economy, cyclical prices are also on the rise. Shares tend to grow faster than the price of robust, because the demand for cars, planes, steel, chemicals is increasing. In the economic downturn, cyclicals suffer, as do price actions. You can lose 50% of your investment quickly if you buy cyclical at the wrong time in the cycle, and it can be years before you notice a return. Timing is very important in this case, and the advantage of the profession can be very valuable for this category of companies. Before buying, analyze the inventory, the relationship between supply and demand, observe newcomers to the market, which can become dangerous. Anticipates per reduction over time as businesses recover from an economic crisis and then peak per when investors expect the end of the business cycle. Sells when inventory stocks increase and the company cannot sell them, which means lower prices and lower profits when the competition has become too fierce, when the final demand for products has slowed down, or when the company is unable to cope with external competition, although it has reduced its costs. 5. Turnarounds. Are companies initially doomed to extinction, but manage to return before it ends? They can go bankrupt quickly and their variations are not related to the variations market. They may depend on government guarantees for loans, e.g. Chrysler or Lockheed. They may suffer major losses from unforeseen events. They may go bankrupt, but somehow recover, e.g. Toys R Us. They may succeed in restructuring unprofitable subsidiaries. Sell if debt rises sharply, if inventory grows twice as fast as sales, or if the PER is too high relative to future earnings prospects. 6. Asset plays. Asset owners, any company that owns something valuable, but the market has neglected. The advantage of the professional matters a lot here. The asset can be a large amount of cash, real estate assets, patents for medical products, etc. Analyzes the value of those assets, the size of the company's debts in relation to those assets, and whether the company intends to make new loans that would make those assets less valuable. Companies do not always remain in the same category. Some go from fast to lazy or robust, others even become cyclical. Some cyclical ones can have big problems, but they recover before they collapse. Examples of choosing perfect actions. Interesting names can attract investors who have not checked the company's fundamentals and overestimate their quotations. Instead, companies with boring names are undervalued, e.g. automatic data processing. It does an uninteresting activity, which keeps analysts away until good news about it starts purchases. If a company with good profits and a solid balance sheet does an uninteresting activity, that's it offers enough time to buy the stock cheaper. Then, when it becomes expensive and fashionable, you can sell the shares of those who come after you. Is not in a fast-growing industry and has no problems with competition, has no relevant rivals and no one is interested in it. It has a niche market, being a virtual monopoly, which allows price control. Examples: pharmaceutical or chemical companies, selling pesticides or herbicides, that own patents for products that no one else is allowed to make, or companies that own brands, e.g. Coca-Cola, Robitussin, Tylenol, Marlboro, that take a lot of money and years to build a public reputation. Uses technology and benefits from declining prices for technological products. Produce goods that need to be bought regularly, such as medicines, juices, razor blades or cigarettes. When insiders buy en masse, which means that the company will not go bankrupt in the next 6 months. When management owns shares, then rewarding shareholders becomes the first priority, while when management receives only salaries, then raising salaries becomes their first priority. When the company redeems shares, thus rewarding investors with growth price per share. Examples of actions to avoid. Shares from the most popular company in the hottest industry, the one with the most favorable publicity, which any investor has heard of and which they buy, not resisting social pressure. The actions in vogue are growing rapidly, but as nothing keeps them standing but hope, and rarefied air will fall just as fast. Companies that are said to be the next IBM, the next McDonald's, the next Intel, the next Disney, etc. Companies that diversify into areas outside their area of competence, which leads to increased losses. Companies that rely on too few customers and for which the loss of a customer, including the state, could be catastrophic for the company. Other interesting ideas from the book. There are 5 basic ways in which a company can increase its profits: reduce costs, increase prices, expand into new markets, sell more in existing markets, revitalize or close certain lost operations.
PER, or P/E ratio, is often a useful measure for assessing whether a stock is overvalued, correctly valued, or undervalued relative to the company's potential to produce value.
It is obtained sharing the current price of the share for the financial gains of the last 12 months of the company. Usually PER is lower for lazy and higher for fast, with cyclic oscillating in the middle. If PER is lower than the growth rate, you may have found a good deal. But if the PER exceeds twice the growth rate, this is a negative criterion. Avoid companies with too high a PER, as they must have an incredible increase in earnings to justify their very high stock prices. Another useful ratio is long-term growth rate plus dividend yield. per. If it is less than 1, it is weak, at 1.5 it is okay, over 2 is excellent. Another criterion is the type of company debt. Debts to banks are bad because if that company cannot repay the loan, then the creditors take their share of the assets and there is nothing left for the shareholders. Debts in the form of bonds on the capital market are better from the perspective of shareholders, as long as the company continues to pay interest. Checking profits after paying taxes can tell you a lot about the company's profitability compared to other companies in the same industry. The companies with the best profitability rate are by definition the operators with the lowest costs, which gives them a better chance of survival in case of damage. Market situation, _. Every few months you have to recheck the company's history, quarterly reports, current earnings, and their evolution. Bad and dangerous ideas about actions. If it has already fallen so much, it cannot fall much further. You can tell when an action has reached a minimum. If it has already reached so high, how is it possible for it to grow even higher? The action is only $3 a piece, how much could I lose? Always actions they come back. When it returns to $10, I'll sell it. I missed this opportunity, I'll catch the next one. The action went up, so I was right, or the action went down, so I think I was wrong. In some years you will gain 30%, in other years you will barely get 2% or even lose 20%. It's part of the game and you have to accept it. The multi-annual average for shares is approximately 9 to 10%. If you can't get more than 12 to 15% on average from buying individual shares, then you better invest in an index fund that follows a global index like the S&P 500 and goes with the market. Allocate at least as much time and effort in choosing a new stock as you do in choosing a new refrigerator. The book abounds in examples of calculations and graphs for various companies. Any mention of a company name represents the choice of the author of the book and is not an investment recommendation. Thank you and have a good read.